Famous investor Charlie Munger once said, earning your first $100,000 is the hardest part of building long-term wealth. After that, things really start to snowball in your favor. Well, DIY investor Reni the Resource managed to clear that six-figure hurdle all before her 30th birthday. So let's find out how she went from 0 to 100,000 and beyond. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for a third straight year and counting. I'm your host, Rob Moise. We've got a fantastic show lined up today, so let's dive right in. Joining us is finance, career, and lifestyle blogger Reni Odetoyinbo, founder of Reni the Resource. She also goes by the moniker Reni the Resource. Reni, wonderful to have you joining us on the show today. Thanks for taking the time.
Yeah, thanks for having me, Rob. I'm really excited to be here.
I have to say, Reni, reading your bio and reading into you, very humbling experience for me because you are, before the age of 30 here, successful entrepreneur, property owner of a six-figure investment portfolio. Those are quite the accomplishments that you've managed to pull off in a really short period of time. Fill us in on some of the secrets to your early success.
Thank you so much. I appreciate it. I would say, honestly, the main thing would be my parents teaching me about financial literacy from a very young age. So I started very early and I started investing at the age of 18. And I would say I took action very early as well. So I bought my first stocks at 18. I got into and I just started learning more and more about money from the age of 18. So it's served me very well. And now I'm almost 30 years old, and yeah, it's been a really good journey since then. I also think I focused on consistency and not just perfection. So I didn't always have the perfect strategy. I didn't always know exactly what to do, but I still focused on being consistent every single payday, and that really worked out for me. So yeah, I'd say those are some of the keys to my early success.
So you were moving things in the right direction, building up that bank account and that investing account. I was busy draining mine and working it down when I was 18 years old. So well done to you. So you built up this personal finance and investing knowledge over the years. What made you want to transition into, creating a business around content creation and educating people about personal finance and investing?
Yeah, so I was actually working at the Bank of Montreal in their wealth management department. I was doing marketing for them, and I was making marketing plans to attract ultra high net worth clients to bank with the bank. And through that, I learned a lot about different investing accounts like, the TFSA, the RSP, and I realized that this was really good information that I was trying to make simpler for these ultra high net worth clients. But I realized that the average person doesn't also know this information. So I would just share it with my friends and stuff like that. But then in 2020, I bought my first house. I was 23 at the time, and I posted my keys on Instagram like, hey guys, I bought my first house. I was so excited. And all my friends were like, wait, what? How did you buy your first house? Tell us more, give us more details. So I decided to make a YouTube video about the process of buying my first house. And then they had questions like, okay, but how did you afford this? And I was like, oh, I've been investing since I was 18. And then they had more questions and more questions. And now it's turned into my full-time job and really me helping other people become more financially literate because I'm very passionate about it. So yeah, I think that's kind of the journey behind how I got into personal finance and content creating.
And judging by some of the comments on your videos, you're obviously making an impact. And I know one of the key demographics that you like to speak with is young women in particular. And we had International Women's Day earlier this month. If you were to put a message out there for young women who want to get started investing, maybe they're a little bit anxious or they don't know where to start, like you were once upon a time, what would that message be to them?
I think that as women, we're often taught that we are not good with money and that maybe we should leave managing money to the men. So I would say that my message to all young women out there would be that you aren't bad at money. You're not bad with money. Maybe you just haven't learned yet. And it's no wonder you haven't learned because our educational system right now doesn't really teach us that at all. So instead of getting down on yourself about how much you don't know yet, instead get motivated to educate yourself because those self-limiting beliefs that you have about money can actually become a self-fulfilling prophecy. So you think that you're not good with money, so then you also start acting as if you are not good with money. But there's a quote by Ramit Sethi, who's a financial literacy creator as well. And he always says, as you build your competence, you will become more confident. So I encourage people to start reading books, start listening to podcasts, just digesting more information about financial literacy in whichever medium you want to, because it will help you to build your confidence and make decisions about your money that you can, be confident about when you're making them.
Yeah, and of course, part of that education process is learning from the lessons like people like you who've been there, done that. So let's dive into our conversation about some of those lessons that you learned building up this six-figure investment portfolio that you have. And for those in our audience, if you want to get in on the conversation, you can do that. We have a live Q&A portion later on in the show here. So make sure you submit your questions for Reni and we'll pose them to her later on. So if you're watching us on Webbroker, you can use the chat box there to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. It should be on the right side of your screen. And if you're watching us on our YouTube live stream, you can click on the link in the description. That'll take you over to the broadcast platform and then you can ask your questions there. Okay, Reni, without further ado though, let's get into it. And your first major investing lesson is to save and invest as much and as early as you can. This is something that was very powerful early in your life, as we heard. Take us through a little bit of like that journey and why it was such a game changer for you.
Yeah, so I would say, let me take it all the way back. When I was very young, my parents decided that they are going to teach my sister and I about financial literacy. And that meant that anytime an auntie or an uncle came over to the house, I would have to put half, and typically in the Nigerian culture, they will give you money as like a token of appreciation or just a gift to the kids. So during that time, my parents would actually have me give part of that money and put it into my bank account. So TD Bank was actually the bank that we opened when I moved to Canada when I was 4 years old. And I would have to put half of that money into the bank account every single time. So I think I grew up learning that you should always put money away from every increase that you get. And now it has served me extremely well. When I started making, let's say, big girl money for my first part-time job, I was very okay with just putting half of my money away into my savings account because I was used to doing that from a very young age. And this really helped me to build up the cash that I then used to invest when I turned 18 and bought my first stocks. And of course, we all know about compounding and the benefits of compound interest, but I truly believe that if you start early, even if you don't have much to invest or save, if you start early, you will really benefit from the benefits of compound interest.
Yeah, and part of that is this idea of pay yourself first that I know you're a big fan of. For the uninitiated here, what is pay yourself first? How does that work?
So concept of paying yourself first is really just putting anytime that you get paid, so meaning that you get a refund, like a tax refund, you get a bonus at work, you get your salary, you get some money, you are always making sure you put part of that money away and paying your future self. So the typical thing for people to do would be that, you get some money and then you spend it all, and then if there's money left over, then you will save eventually. You'll save from the leftover. But the method that I like to use is pay yourself first, where I say, okay, I know I want to save $100 from every paycheck. So before I spend any of this money, I'm going to take $100 and put it away into a savings account or put it away into an investing account. And again, this allows you to ensure that you are consistently thinking about your future self, not just satisfying our needs that we have right now.
Yeah, I mean, it's tremendously easy to spend money that's in front of you, no question about that. I know everybody's situation is a little bit different here in terms of what they're able to save, but as a general rule of thumb, do you think that there's a percentage of their paycheck to set aside each month for saving and investing that somebody might want to shoot for?
I think experts typically say that about 20% is a good number that you should put down every single month. I think it's a good start. And if you can put about 20%, that's great. But I do know that everybody's individual situation is different. Some people live in extremely high cost of living cities, whereas other people live at home and they don't pay much rent. So, they can afford to put a larger percentage. So I think the main thing would be to actually look at your numbers and see how much you can realistically put down every single month. Because when I work with people, I find that they say, okay, 20%, that's the number I should put down. But then we look at all your other numbers and we see that, maybe you can put a bit more because you are not paying very high housing costs. So maybe you can put down 30% or 40%. So again, it's an individual decision that everyone should look at their numbers and decide on a number that makes most sense for them.
Yeah, and certainly another thing that, when people go autopilot like that, and then they get a raise at work or something like that, and they can actually put aside more money, but they don't think to, right? So you always got to review your situation and make sure you're saving the most as you can here.
Yeah.
Okay, I want to take a quick pause in the action here because I have a little bit of a trivia question for our audience here related to saving. And the question goes like this. What percentage of disposable income did the average Canadian household save in 2022? So we have a couple options here for you. We got 6%, 10%, 14%, 20%. We're going to reveal the answer in just a moment here, but Reni, would you care to venture a guess?
I don't, I feel like it's maybe 10%. Yeah, let's say 10%.
Yeah, I think one thing we can confidently say here before we reveal the answer is it's not as high as it should be, right? We know that, but 10%. Okay, well, let's see. The actual answer is, we can reveal this now, it's actually just 6%, if you can believe it or not. And that's according to data from Statistics Canada. And that 6% works out to roughly $1,750 per year for the average household in terms of the disposable income that they're putting aside here. So obviously 6% is pretty far away from 20% or anything like that. And I think for a lot of people, it can be really difficult to scrounge up the money to save and pay yourself first, even though you might want to. Do you think that there's anything they can do, Reni, to help, whip their finances into shape and squeeze out more money to save? Anything they can do?
Yeah, I think that as I said earlier, it's important to just take a look at your finances, because I find that a lot of people say, oh, I can't save, but have you looked at how much you're spending each month, and are there any places that you can cut back? Sometimes we have a spending problem and sometimes we have an income problem, right? So I think it's important. You won't know if you have either one if you don't actually look at the numbers. If you have a spending problem, then let's see, are there any areas that I can cut? Obviously not the essentials, but are there any discretionary spending things that I can cut? If there are, then we're cutting them, and then we're redirecting that money to something else. We're not just leaving it there, we're redirecting it. And ideally you automate those savings so that whenever you get paid, the money is automatically coming out and going directly into your savings account. If it is an income problem, then that means we need to start looking for maybe a raise at work. We're looking for a new opportunity that will pay us more. We are looking for a side hustle. That is what I would really suggest if you are in that situation.
Yeah, and the 50-30 budget, which is the graphic that we just had up on screen there, that's kind of like one of those rule of thumbs that people can consider when they're looking to budget and kind of squeeze out more money too. Something to think about. I know that's one that's really popular amongst the personal finance bloggers and such. Anyway, let's keep this train rolling down the track here. Let's get to your second investing lesson, and that's to keep things simple with your investing strategy. So what does simple look like for you, Reni?
To me, I would say simple investing means that I am picking 2 or 3 funds and I am sticking to those. And when I say funds, I mean ETFs, which are exchange traded funds. These are funds, these are basically a group of stocks and other financial instruments that are put into a fund, and we invest in that. I know individual stock picking is all the rage, but I think the average person doesn't have the time to dedicate to it. They don't have the desire to actually manage individual investments. They also don't have the knowledge to manage their individual investments. So I'm big on keep it simple. Look at ETFs. These are broadly diversified investments that can be across Canada, the US, across the world. For example, one of my favorites is an S&P 500 index ETF, and this basically holds the 500 largest publicly traded companies in the United States. So I have done my research on these funds. I love these funds. I've been investing in them for the past 4 years consistently. And I think the next step, once you've chosen what you want to invest in, is to then automatically transfer the money. So I make it so that every time I get paid, I also pay myself, and it's automatically transferred money from my checking account directly to my brokerage account, and then those funds are invested as well. So I found that this helps me to just focus on the long term rather than the short term. Right now, we know the market's a little shaky right now, and there's a lot of noise, and people are selling their stocks. But because I've created a strategy that's very simple and it's for the long term, I don't really get shaken by the noise that's happening in the market right now.
I think it's really interesting to hear you talk about the virtues of index investing and how you made that pivot, because you used to be a stock picker yourself back in the day, and those stock picks did quite well for you, right?
Yes.
I think some people might wonder, I appreciate the value of keeping things simple, but if somebody wanted to do something like how you did, making a six-figure portfolio like that over time, do you think that they need to pick stocks to have a chance to do that? Or do you think, in your case, for example, you could have gone the index approach and still achieved that six-figure portfolio roughly in the time that you did?
I think that if I went the index approach since like day one, it would have taken me longer to reach the six figure portfolio mark, but I still would have reached it. So I think that, of course, there is the opportunity to have extremely great growth. As everyone knows, that's how I was able to purchase my house. So there's an opportunity to have extremely great growth from your individual stocks, but with big risk or yeah, with big risk comes big returns, but also comes the opportunity to have big losses. So I think the average person, again, just doesn't have the discipline and the knowledge to actually research the stocks that they're picking. So I see a lot of people losing a lot of money, and it hurts. So I think the average person would do better if they simply invested in an ETF or an index fund.
One of the things I find most compelling, and we actually have a chart on this called Measuring Up, and it looks at these reports by S&P Global. They put out these reports called SPIVA, and they look at the performance of Canadian equity funds that are like actively managed by a fund manager or what have you, versus just how did the benchmark index perform. And over the long period, 10 years plus, it's something like 90% of the time the market will outperform, or rather the market has outperformed 90% of these funds. So it really goes to show just how difficult stock picking can be. And if you aren't really wanting to get into that nitty gritty, you can still create wealth taking the passive approach as you are now. But let's reset things for you here. Let's say you have to start from scratch, Reni, and you have $1,000. What would you do today?
So if I had $1,000 and I also have a job that's paying me on a regular basis, I would take that $1,000 and I would split it between a Canadian ETF and then also a US index ETF. And I would regularly invest in them from each payday that I have. So again, that $1,000, $500 goes to a Canadian index ETF, $500 goes to a US index ETF, and then every single time I get paid, I'm just adding more to those positions. And that's it. I think it can all be that simple for most people.
Yeah, it doesn't always have to be super complicated, right? We can keep it simple. Now, you talked about liking index funds. There are like hundreds of them to choose from, though, so I can see people getting analysis paralysis here. Are there particular things that you're looking for when you're researching which one to choose that leads you to ultimately choose one over the other?
Yeah, so there are a few things. I would say the first thing would be a relatively low management expense ratio. So for those who may not know, when you are buying funds, somebody is managing that fund, so you do have to pay them a fee. And there are funds that have extremely high fees and funds that have lower fees. So I like to look for ones that are low cost, low fee, and that's called the MER. And I look for ones that have 0.2% or less for an MER. Also, I look for ones that have relatively high assets under management, because these tend to be more stable in general. The company has been managing lots of assets, so I trust them a bit more. I also look at which index that the specific ETF tracks. So I like to track the popular ones that are well known, like the NASDAQ, S&P 500. Those are the big ones, and I like to track those. And then also, I look at which sector I personally want to focus on. So am I really interested in investing in tech or in semiconductors, or do I want a broad-based one that is well diversified across all different industries? That's typically what I look for. And then lastly, I would say, or the last two things would be the risk level as well. So what risk level am I personally comfortable with? So I want to invest in a really niche do I want to invest in a really niche ETF that may be a bit more risky because there are less companies there, or do I want to invest in something more broad? And lastly, it would just be the performance history. So I know that past performance does not necessarily mean that it will be a great investment, but I do think it helps me feel a bit more confident in how it has performed in the past.
Okay, so some great criteria to work with here. Thanks for filling us in on that. Just a quick note for our viewers here. Are you guys enjoying the show so far? Because if you are, make sure you check out TD Direct Investing on YouTube, on Facebook, and on Instagram. You can follow us there to get a sneak peek at upcoming shows and also a ton of other educational content to help you level up your investing game. So make sure to check it out. All right, Reni, let's move things along here. And like we were talking about, you used to be a stock picker before you kind of shifted to that passive index investing approach. And some of your stock picks did really well for you. And one of the reasons that you attribute to your success in that respect is focusing on the fundamentals. So what are the fundamentals for those who don't necessarily know what that is? The last time I heard the word fundamentals, it was like gym class and my teacher was talking about my jump shot in basketball. What are the fundamentals when it comes to investing?
Yeah, so the fundamentals are basically when you are evaluating a company's financial statements and the other economic factors, so that we can see what the value of this company is. So we can see if the price that it is currently trading for is a fair price to pay for it. So I am looking at a bunch of different things, all these different financial metrics for the company. I'm looking at it just to see, is this company worth what the market has currently valued it at? Because sometimes companies are overpriced, sometimes they're underpriced. Of course, an underpriced company would be the best for me to invest in, right? Because then there's more growth potential. And there's a few metrics that I look for if you want me to go into those as well.
Yeah, let's dive right in. What do you like to look for?
Okay, so I would say the first metric that I look for is the revenue growth. So I look at how has this company been growing year over year. So compared to last year, what has the revenue been compared to this year, right? And I typically look for 10% growth or more, or if it's in a high growth industry, maybe 20% or more. But I just want to see that this company has been improving year over year, not getting worse every single year. I also look at the net profit margin. So how much profit are they actually making after all their bills are paid and everything is paid for? What is their actual profit? And this is typically 10% or more that I'm looking for year over year. And maybe in tech, 20% or more. And in retail companies, usually 5 to 10%. But I think 10% plus is a good benchmark. I also look at the debt to equity ratio. So how much debt do they have compared to the equity that they have? And I typically look for a company that's below 1. And I would say the last thing that I look for is that PE ratio, and this is typically 15 to 20 percent, 15 to 20 that I'm looking at. And of course, it depends on the industry that we're in, but those are some of the key qualities or quantitative metrics that I look for. And then if it's qualitative, I also am looking at what does the management team look like of this company? Is the management, or are the founders still invested in this company? Are the management team invested in this company? Are there any issues that I'm seeing in the news that have to do with the management team? Like, those are some of the things that I'm looking for. Also, industry trends. Is this an industry that is currently booming, or is it something that's dying? Those are some of the different factors that I look for when I am looking at a company.
Right on. And I know a lot of young investors obviously tend to gravitate towards things like growth stocks because they have a long time horizon to invest and they're looking for the biggest potential growth. Sometimes those growth stocks, particularly in sectors like tech, have these really big price to earnings ratios that almost defy logic. And it's kind of hard to value these companies. So what do you do as somebody who invested in stocks like that? How do you make sense of really high PE like that?
Yeah, sometimes PE ratios just don't make sense, and it could seem like the company's overvalued. But that's when I really lean on the qualitative metrics, where I'm looking at the industry trends. I'm looking at, do they have a competitive edge in their industry as well? So who are the competitors? Do they have what we call a moat around them, where nobody can really touch them because they have that competitive edge and they have, what do they call it? The unique selling proposition, where they don't have real competitors, or maybe the competitors are miles and miles apart. So those are some of the things I would look for if that PA ratio is also absurd as well.
And where do you like to go to get some of this fundamental information? It's great that you kind of gave us some of those metrics that you like for. What are the places you go to find this stuff?
So looking at the company's financial statements is something that I do, just simply going on the websites of the company and looking at their statements, their annual reports. Also, Google Finance, Yahoo Finance, they have some great websites. And also TD Direct Investing's platform has analyst picks within the platform as well. So I love to just see the analyst reports because, of course, they're experts. They know way more than me. So I like to read what they have written as well. If they are saying this is a buy, a hold, sell. So those are some things that I look for.
Yeah, it's always nice to get those research reports by the professionals just to give you more perspective and ultimately help you make your decision one way or the other. Now, I would be totally remiss if we didn't talk at least a little bit about the market volatility that we're seeing, in large part due to some of the Trump administration's policies and all the things happening in the United States right now. Your last investing lesson really speaks to that, and it's to tune out the market noise and just stay invested for the long term. Why are you confident staying invested amidst all this uncertainty and all these fears about market downturns and stuff like that?
I think I'm confident in it because over the past 10 years of investing, I've just seen a lot of ups and downs over those times, but the market has recovered every single time. So again, 10 years of investing, for example, 2020 would be the most recent one, and that market crashed. And if I was so scared that I took out all my money there, I would have lost so much money. So I think it gives me the confidence that all the terrible events, we've recovered every single time. And it's not to say that the individual stocks all recovered, but because I'm invested in the broad market, I'm very confident that it will recover. And I always remember this quote that says, when in doubt, zoom out. So a long-term investor doesn't really concern themselves with short-term volatility, because if you zoom out, you'll see that over the long term, the market has always gone up. And if anything, I would say that time gives you that time when there's a crash gives you the chance to buy those stocks at a discount or at a cheaper price. So I'm happy with it, and I will continue to purchase my picks. But again, it's because I've researched what I have chosen. So I'm not just investing in random things. I've researched these things, so I feel very confident investing in them for the long term.
Yeah, it's funny. We always like to think this time is different. The terrible event du jour is going to throw off the market and it'll never recover and stuff like that. But one of my favorite charts to look at, and we actually have it here, it's called Staying the Course. And it looks at the S&P 500 as an example here and all the terrible things that happened over the last 40, 50 odd years. And yet here we see the market continuing to grind higher. We don't know what's going to happen in the future, obviously, but it does give some investors some confidence to say, hey, maybe the world isn't ending the way I think it could be in the moment when you're very fearful. All that said, are you changing anything about the way that you're investing these days, given all this volatility and uncertainty?
To be honest, I have not changed anything. I would say maybe I've added a few more Canadian ETFs rather than simply, because I was a very US heavy focused investor. And I still believe the US, of course, great economy, but because of what's going on in government right now, I'm not exactly sure of the long term. So I'm still investing in those, but I've also added Canadian and emerging markets ETFs to my portfolio so that there's some geographic diversity in my portfolio. But in general, I don't like to make big decisions when, again, these scary things happen in the world, because emotions aren't helpful when you're trying to make rational decisions about your investing portfolio. So pretty much I'm sticking to the plan right now. We'll see over the next few months what may happen, but I'm sticking to my plan for now.
Okay, very, very sober second take on the markets here from you. Very, very sage of you. Thanks for sharing your insights there on how you were able to build up this six-figure portfolio, Reni. I want to move on to a segment that we like to call Hot Takes. Okay, we've heard a lot of interesting perspectives on our program in the past, so I wanted to bounce some of those ideas we've heard, see if you agree or disagree and why. So how does that sound? You ready to go?
Yeah, sounds good.
All right. So our first idea, this comes from personal finance speaker and author Sandy Young, and she says buying the dip during the recent market downturn could be a savvy move for long-term investors.
A lot of people are fearful, which I mean is totally normal. But if you do have the opportunity to invest more money into the stock market while it's down and could be continuing to go down for weeks, if not months, who knows? So much uncertainty out there, but it could be an opportune time to put more money and invest it for the long run.
So Reni, you were just saying earlier how this idea of buying stocks on sale or the market on sale can be a good move. That's called buying the dip. But I'm curious, you personally, do you have the stomach for it right now with the way things are going in the US market? You talked about moving more to some other asset classes. Would you buy the dip on the market today? Is that something you're doing?
I am buying the dip. So because my investing philosophy hasn't changed, every 2 weeks I am buying. And because the market is dipping right now, I'm basically getting all the stocks that I would normally buy for a cheaper price. So yes, I agree with Sandy. I am buying the dip. I'm team buy the dip.
Okay, I want to stick with this buying the dip theme here for our next idea. This one comes from DIY investor Bilal Dalich, and he says that he likes to do a kind of a variation of buy the dip. It's kind of called strategic dollar cost averaging is the moniker that he gave for it. So let's hear how it works.
I'll give you an example. If I like a certain stock, and what I will do is I'll make that first initial plan that I'm going to put $5,000 into this stock. Now, I don't want to invest the full $5,000 because I might be uncertain. Maybe the stock price is too high. Maybe the macroeconomics in the future don't look too good. But I do really love that company. So how do I kind of, relieve that itch I get to buy that stock? So I'll make that first initial investment of $1,000, okay? And then I'll wait either a month or a week. And if the price goes down maybe 10% from there, I'll make that other initial investment of $1,000. And maybe if the price goes up another 5%, I'll put maybe another $500. So this is a strategic, a more strategic way of dollar cost averaging. Because we also have...
Okay, so Reni, what do you think about this idea of spreading out the available money that you have to invest in a particular stock or index or what have it? Would you prefer personally to just put all the money in right away and just make the call if you're confident in it? Or do you like this idea of spreading out the money over time?
I do like the idea of spreading out the money over time. And I am big on dollar cost averaging. I think, again, it's about the stomach that you have. And right now, or in general, I don't like to put huge lump sums into stocks. I like to see them over a period of time. So I agree with Bilal as well, where if I had $5,000, I probably wouldn't be like, okay, if it goes up 10%, I'm going to invest this. If it's down 10%, I'm going to do this. But I would be putting maybe every 2 weeks or every week, I put $1,000 of that $5,000. That's probably what approach I would take to it.
Okay, so a little bit more of a systematic approach as opposed to like trying to time the market, so to speak.
Yeah, I'm not a market timer. I feel like because I would consider myself to be a lazy investor where I'm not checking my portfolio on a daily basis or anything. So that wouldn't be something that appeals to me. It would be more of a, let's spread it out over a 5-week period and put some money in the market.
Somebody once told me that investing in your investment portfolio is like a bar of soap. The less you touch it, the better you're going to be. The more you touch it, the smaller it's going to get, right? So maybe not checking every single day. Maybe there's some wisdom to that, right? Okay, we got one more idea here. This one is from Ryan Lee from Twain Financial, and he disagrees with the conventional wisdom that we sometimes hear that Canadians earning less than $50K per year should focus on a TFSA over an RSP. So let's hear his logic.
When you're making less than $50K, yes, you're in a lower tax bracket, but your marginal tax rate is still going to be like 20%, right, based on BC tax rates. So this means that any contributions you make to your RSP, it will still give you 20% back in tax savings, right? So for example, if you save $5,000 a year, assuming we reinvest the tax saving back into the RSP with a 6% growth, you would basically get $5,300 after year one, right? And it'll jump to $13,000 in year two, and eventually by year 6, you would have $51,000 in your RSP account, right? Now, let's compare that to if you save the same amount of money. You save $5,000 in your TFSA, you still have 6% growth, but now you would only have $37,000 by year 6, right? So that's right there. It's $14,000 extra, or that's 38% more when you're using RSP versus TFSA.
So Reni, what do you think about this debate here? Where do you stand on things? For somebody making $50K a year or less, TFSA or RSP?
I understand his point, but generally I like the TFSA first due to the flexibility of withdrawals and the fact that there's no tax or penalties when you do withdraw. And I think typically when I work with people who are making around this amount of money, they typically may need the money in the shorter term for maybe some long-term goals or some life goals that they may have. So that's why I prefer the TFSA, simply because of the flexibility. I totally understand what he's saying about the tax benefits and you can reinvest the tax savings and everything. But I think that I really do like the TFSA based on the flexibility. And I do think it's the easiest way to start. If you want to save for a wedding or invest for a wedding, if you want to put your money away for your car, whatever it is, you can put the money in your TFSA and grow it and take it out tax-free. I think I personally like to focus on the RSP when you're earning over $70,000 to increase that effectiveness of your tax savings from those tax deductions. But I do always emphasize that if your employer is making matching contributions, then you should always, always, always prioritize those matches, because this is basically free money. And then I also like people to consider the third option, which is the FHSA. I think the FHSA is honestly the best of both worlds. You know, you get that tax deduction that the RSP has, but you also get that tax-free growth that the TFSA has. But of course, the money can only be used to purchase a house. So that's the only con of it. But I think they're all great accounts. Personally, I start off with the TFSA when I think about it.
All right, so I appreciate your perspective on that one. It's a hot topic. I'm sure that debate will continue to rage on, but nice to get some perspective from you there. Now, we talked earlier about the importance of doing research before you invest in specific stocks or the market in general, and how you like to consider stock analysts and their reports as part of your process. So on that one, I'm going to throw it over to my colleague, Caitlin Cormier. She's going to give us a tour of WebBroker's Analyst Center.
Let's start by going under Research and clicking on Analyst Center. This is the hub for different ratings that have come out about individual stocks. So we can see here, these are the most recent ratings. These have all come out today. So we can see these individual analysts and what they have as far as current ratings for these particular securities. We can filter through these most recent ratings by analyst recommendation, by rating, by country, market cap, or sector, if we want to sort of filter them out a little bit further. We can also click here to see trending stocks. Under trending stocks, we can see either the most rated, best rated, or worst rated companies. So what we're seeing now are the most rated, so they have the most number of analysts currently covering these stocks. We can break it down to a different period of time, a country, market capitalization, sector. So lots of ability to sort of take this information and filter it down a little bit further. If we're looking for information on an individual security, we can go ahead and just click on that company's symbol, and we will get to the kind of landing page for that company. First, let's go ahead and click on reports. So this is where we can find a deeper dive into kind of what the analysts are looking at in order to make these different recommendations. We have reports about insider trading, as well as the Argus, Morningstar, and Thomson Reuters and Vickers insider trading chronologies. So these different reports, you can click through and find information about the financials, as well as comparisons of peers and a more in-depth review of the company and how the analysts got to their individual ratings. If you're looking for more information on those ratings specifically, we're just going to click on the Analyst tab. And this is going to bring us to the Analyst Center for an individual security. So what this is showing us is the 12-month price history for this particular stock. And it's also showing us a projection for the next 12 months. So analysts, in this case, there's 42 analysts, have offered a 12-month price projection within the last 3 months. The high, average, and low price for the stock are listed here. On the right, we can see what the consensus is. So majority have said this particular stock is a buy. Some say it's a hold. And then if we scroll down a bit lower, we can see who the analysts are that have actually provided these ratings. If we click on the individual, we can see what their win-loss rating is. So how many successful out of total ratings they have. Again, we can click to a couple different just to see what their ratings look like and see what their kind of win-loss percentage is. If we find a particular individual we'd like to kind of see more about, we can click View Profile. And this is going to give us a bit of the same information, but a little bit extra too. So it shows us the ranking for this particular analyst. So this one is actually 6 out of 9,400 analysts, their average return as well as their success rating. And then down here, we can see what their stock rating distribution is. So how often they kind of use buy, sell, or hold as a rating. And then on the left here, we can see the different companies that they currently cover. We can go ahead and follow the analyst. And if we want to see all of the analysts we currently follow, right here at the top, we can see it says followed analysts. And here is a listing of all of the analysts we may have chose to follow. So we can kind of keep up to date on what current ratings they have.
All right, Reni, we're going to have to leave the interview portion of our conversation there, but we're not done yet. Okay, we're going to open the floor to see what our viewers want to know more about. So are you ready to see what they want to know more about?
Yes, let's get into it.
All right, let's see. We have one coming in here from Deborah. Deborah's got a 3-part question here. Deborah, I'll allow it, although that's kind of cheating. But what were your individual stocks that helped you reach your 6-figure portfolio? How did you choose them at age 18 when you started off? And did you already know about things like fundamental analysis at that age?
Okay, great question. So first question was, what stocks did I invest in? So of course, it's not financial advice. I'm not telling you to purchase any of these, but back then I invested in Shopify when it was like it wasn't a huge company at that time, let's just say that. And I invested in it when it was around the $200 mark, and I bought a bunch of them at that time. And by the time I sold them about 5 years later, it was around the $1,000 or $1,200 mark as I was selling them. So this is pre-stock split. Right now it's much cheaper, but it's pre-stock split. So yeah, that was one of the main stocks. I also had a lot of the big banks in Canada. I had BMO and TD in my account as well. So those are some of the main ones that I had. I'm trying to remember others, but I think those are the main ones that were in my account.
And what about things like fundamental analysis, and how did you come to pick these stocks to begin with, especially at such a young age?
Yeah, I don't think I was the most literate about in fundamental analysis. I think that my dad also invests in the stock market, and he has been investing in the stock market. So he would often tell me stocks, and he would say, go and research that. So I would go and research the ones that he would recommend for me. I would also look on a website called The Motley Fool, and they would talk, like same thing, basically give analysts stock picks, and I would go and look at those. But I started to listen to a lot of podcasts and read a lot of books at that time. So I think I had a little bit of knowledge, but definitely not what I have at this point. And I think that's an important lesson for everyone, that you don't need to know everything in order to start. You just need to start. And again, I wouldn't say that individual stocks is the way to go for everyone, because that could have turned into me losing all my money as well, right? But it turned out well for me in that situation.
Well, glad that it worked out for you that way, for sure. Let's keep this train rolling here. Holly has a question for us, and Holly wants to know, if I maxed out all of my registered accounts, then should I start thinking about buying real estate or open a non-registered account? Sounds like Holly has a good problem to have here, if you want to put it that way. What do you think are some of the things she should consider?
Yeah, that's a great problem to have. Congratulations on maxing out your registered accounts, Holly. I would say that it just depends on your long-term goals. Real estate is a great asset class. Stocks and ETFs are great. So it just depends on what your long-term goal is and what you want to do with the money. If you're investing in real estate for investment, then just run the numbers before you purchase your house and make sure that it's actually a profitable venture, given interest rates right now and what market rents you can get. And if you want something that's more liquid, because obviously a house is not as liquid as the stock market, if you want something that's more liquid and you can take the cash out at any time, then non-registered accounts are a great way to go. But congratulations on maxing out your accounts. That's an amazing feat that I don't see many people being able to achieve.
Yeah, that's something that a lot of people don't achieve in their entire working lives. So really well done there, Holly. I think we have time for maybe one more question. This one's coming to us from Amy. And Amy is saying, wow, Reni, I'm so impressed with your successes. But what about some of the mistakes that you've made in the past that you now look back on, and what you kind of learned from them?
Great question. I would say I have had a few mistakes. One of the main ones, which is not investing related, was simply not budgeting. I know that people have mixed reviews about budgeting. People think that budgeting is a very limiting thing, but I truly believe that when I started budgeting, I was able to see where my money went instead of wondering where my money was going every single month. So I think that was my biggest mistake. If I started budgeting a bit earlier, then I would probably have a bigger portfolio now because I would be able to see exactly where my money was going. It wasn't until I wanted to buy my house that I started to really budget because I had, of course, a down payment to save for. So then I was, very active in my budgeting. But that's one thing. And then the second thing would be investing in stocks without doing any research. So as I said, I used to do a bit of research before I would buy, but sometimes I would see a stock on Twitter and I'd be like, oh, okay, let me invest in this. For example, a lot of the cannabis stocks that came out. And I don't know if it was 2018 or so when cannabis was legalized in Canada, but at that time, I was like, okay, let me invest in some. So I bought 2 different cannabis stocks. One did extremely well for me, one didn't do so well, and I lost all my money. So that would be another mistake, just buying stocks without doing the appropriate research before purchasing them.
Yeah, it's a decision that should always be made carefully, not on the whim of a tweet or a post or what have you. So a good lesson learned that I think a lot of people should take to heart. Reni, thank you so much for joining us and for taking some of those viewer questions with us. Really appreciate you taking the time for us. And for those in the audience, really appreciate you guys tuning in as well too. Remember, we run this show every Thursday at 2 p.m. Eastern. You want to tune in next week because we have a really interesting conversation coming up with Veronica Popova from Vanguard. We're going to look at this idea of VFV and chill, or VOO and chill as it's sometimes referred to as. The idea here being that you're investing in an S&P 500 ETF, contributing to it regularly, and then that's all. And you look through everything else. This is all you have in your portfolio. It's one that's popular on Reddit and social media. Is it right for you? We're going to dig into that. But for now, that's all the time we have for today. Thank you so much for tuning in. Thank you for joining us, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.